So, hello together to statistics. We are almost at the end of the lecture, and yeah, in order to do some practical things, I have introduced you into linear regression and into correlation analysis, and we introduced the traditional model of financial markets, the so-called Markowitz model. There we deduced the so-called capital market line and the market portfolio, where we then interpreted the market portfolio. I just show what I mean. So in general, in the financial market, we are modeling the yield by the average or the expected yield I can get investing in some assets, and unfortunately the prices of these assets move up and down in the future, and therefore we have some volatility, and this volatility we are measuring in the standard deviation. And then we talked about what would be the efficient way to invest in risky assets. This we just modeled with two assets, and these assets, the price movement should be in general be correlated, and there we obtained the so-called efficient frontier. So every point on this efficient frontier represents some investment in a portfolio structure in risky assets, and we obtain then some risk profile consisting of our expected value, for example mu1 and sigma 2, or then due to our assumption of risk aversion that higher yields should then also coincide with higher volatility. And this we combined with a non-risky asset, in general investing in government bonds, for example, of large and stable countries. So you can think of investing in government bonds, in German government bonds, or in government bonds in the United States. And there we said, okay, we have some riskless yield R0, and combining this riskless investment with a possible risky portfolio, we then calculated for this so-called triple structure, because our risky investment, this was a risky portfolio investing in two risky assets, and now we have a third investment opportunity into a riskless asset, maybe government bonds of some large and stable country. And then we obtained, by optimizing the new efficient frontier, here we also need frontier, including including the investment possibility of an riskless investment with then risk profile R0 and 0 because there is no volatility. And this efficient frontier we deduced then from the condition that this capital market line in the efficient way has to touch the efficient frontier of the riskless investment, and the touching point, this is then the so-called market portfolio. What is this market portfolio? This is an investment. We obtain the yield mu m with the standard deviation sigma m, and this can be interpreted then as the average risk within the financial market. And yeah, from this standard Markowitz model, we then switched the last week to the so-called CAP-M model, the capital asset pricing model. Capital asset pricing model, and this is more or less a general equilibrium model where you just model demand and supply of your assets within the financial markets at the stock market exchange. And from this equilibrium model, more or less in the same conceptual way as we deduce the capital market line, you obtain a security market line which measures the risk of every single security, of every single investment in relation to the market risk. So this was our market portfolio in the Markowitz model. And this, then you see here, we have more or less the same structure in this security market line that you have here. The difference of the yield of the single security mu I minus the riskless yield R0, and this equals then some constant, and this is called beta. This is a famous beta factor times the difference between the yield and the yield of the market portfolio with respect also to the riskless asset. So again, here we have the same interpretation as by the capital market line. If you are invested on the capital market line above the market portfolio, then you prefer as an investor a higher risk than the market risk, or if you below this market portfolio, then you prefer a lower risk with respect to the market portfolio. And in the security market line, SML and often capital market line, we have the abbreviation CML. Then you can say that you are, if this beta is larger than 1, then you have a higher risky asset with respect to the market risk. And if you have a beta lower than 1, then you interpret this that your investment, your security has a lower risk than the market risk. And what we want to do now is, just calculating from market data these beta factors for single securities. And for this, of course, we have to ask what will be the yield of a single security. Of course, this is the price development of some asset. So for this UI, or what data should we take? Should we take in order to estimate the beta factors? And of course, then for mu I, we take historical yields of single securities. What should we take for R0? For this, we also already talked about it, and also we talked about it last week. For this, we could maybe take interest rates of government bonds. Or what we also can take is some average interest rates within the interbanking market, within the financial market, because we have there interest rates which are fixed every day. So every day the financial institutions are exchanging billions of assets every day, and for this they every day fix some reference interest rates. And I don't know, do you know how this reference interest rates within the financial market is called? This was some years ago. It was massively in the news because we have the manipulation of the large banks in London, which manipulated these interest rates. This is the LIBOR interest rates, or for the European Euribor, yes. So, or we can take the reference interest rates of the financial markets, and this is LIBOR, or for the European market it is the Euribor. So, and what is this? If you are talking about, I want to take some reference, when you have investments, derivatives, obligations, or something like this, then you always take some reference yield, and there quite often you say, if you take risky interest rates versus fixed interest rates, then you quite often say the fixed interest rate should be the reference point, should be the LIBOR interest rate or the Euribor interest rate. And this is every day fixed within the banking market. Yeah, the LIBOR still in London, and the Euribor, I think it has moved to Frankfurt right now, because you know that UK has left the European Union. So, and then we have to ask ourselves, what should we take for the market yield? What can we think of there? So some average price development in the financial market. What could we take? I don't know if I have talked about this already last week, but what could we take? What would be just my, or also from an individual point of view, what would be quite often my benchmark? If I compare my investment, was it a good investment or not a good investment? Yes, of course. The MSCI World or the S&P 500, or if we go to Europe or to Germany, then of course also we can take the DAX index. So for this, a large stock market index, for example, S&P 500, MSI World, DAX, Nikkei, or the Dow Jones. And yeah, maybe anecdotally, do you know why the oldest one is the Dow Jones? In the United States, around 100 years old. The DAX was then introduced in 1987, so it was not that long period. Do you know where it come from? Maybe you're in some financial management or other courses, you have talked about it. Why? Well, this is really was invented from some guys who thought that they could find some specific pattern within the movement of financial prices. So if you take some securities price and T, and then quite often you say, well, maybe if you go to some side of a large bank, then you see there is some specific corridor. And within this corridor, you have the so-called Fibonacci cyclus or something like this. So that every 7 years, there has, due to purely mathematics, no fundamental research has done. Is it a good? Is this a good company, or what is this company are doing? You just say you go to the mathematics, and then you think that there are some cycles within this price movement, or then you say something like this is called a neck shoulder situation, and there the price has to go down or something like this. And from these guys have then invented these average measurement instrument of the Dow Jones index. This just a historical anecdote, because in our times now, of course, we take the Dow Jones as really a serious way to measure market risk. Okay, so now we are in the stadium that we say, what do we take? Of course, we take here the yields of the single securities for R0, then I choose now here the Euribor, because we will do it then for the German capital markets, and for this mostly the reference interest rate is then the 3 months Euribor. And if you go to financial web pages, then you find, I think, the Euribor you have periods from 1 month to 12 months, I think. But in general, the 3 months Euribor is taken as the general reference interest rate. But of course, there is no law that you have to take this. You think about what you want to do, and then you can choose, hopefully in a good way, which data you want to take. So let's take 77, I think. More or less. Okay. So, and here, let's take this in red. So we take, of course, the historical yields. We take the 3 months Euribor, and for Germany, we will take the DAX. And which single securities then we want to compare with the market risk represented by the DAX, then we take the individual DAX titles. So this will be the individual DAX securities. So, but now we have to think about statistics, and we have to pose the question, which period and which frequency should we take? And I think from your introductory courses and from this course here, and in general, it is quite clear that the more data I have, the better is my statistics in general. So, and of course, we have daily data for the price movements within our financial markets. And we also know, I told you, that we have daily data for the reference interest rate, that the Euribor and LIBOR are fixed every day. So why not daily data, which is accessible? So this would be maybe the first thing what I'm thinking about it. But then I have to think what within a day or within a week, what are these prices are doing. Then they really depend on single events, and then I can think of that my data is highly correlated to each other. That the price today is highly correlated to the price yesterday. And what I want to do is to take more or less a random sample where I have hopefully quite independent events. And therefore, this is an argument against taking daily data in order to calculate the general risk of my security. Because this then could mean that I calculate the risk, and maybe that I obtain a very high risk compared to the market risk. But this risk, since the price movement of, let's say, 40 days, because there was some specific single event for this company that you are looking for at a period, let's say for 3 or 4 years, and that your risk then is only driven by more or less 40 days. Because these price development of a month or 2 months was so large that your total risk over the last 5 years is mainly driven by this single sub period, and this is an argument against it. So we can say, but daily data can be in general highly correlated, and this could mean that the general calculated risk of a single security is mainly driven by a short sub-period. So this argument then, of course, would say, well, let's take a very low frequency. So why not taking daily data? Why not taking yearly data? Well, there, of course, we have the same arguments, just in the other direction. Then, of course, the sum of your data points goes massively down. And of course, we say, well, you need at least 20, 30, 100, or 1,000 data points in order to do really interpretable statistics. So this would mean, but then the sample size goes down. And what else could happen? Well, then you say, then let's increase our period we are looking at. Then let's say, let's look in the history to the last 30, 40, 50 years. Then I would have again in general enough data to do statistics. But what could happen if I increase the period? So then we should increase the whole period we are looking at. But what can happen then? I think we are going then back the last 30 years. So for example, we go back the last 30 years. what has happened in the financial markets the last 30 years. If you think about historical events, and what would this mean for the quality of your data? Yes, of course, but then .com, roughly 2001. Financial crisis, of course. Financial crisis, 2008, 2009. And where did we have the last crash? At the Corona, of course. And we have the Corona crisis 2020. So, and these historical events, what does these historical events means to your data? This means that the framework you are looking at has highly changed due to these crises, due to these events. So, and when you are doing statistics, then you also be interested in a stable framework. Because maybe then you are measuring some high risk, but this high risk then could be possible that it is not dependent on the single security, but that can be just caused because the whole world has changed. And then to interpret your data, is it an individual risk or is it only a market risk, or that everything has changed? This you cannot distinguish maybe. So, but this means that the framework of financial markets has highly changed in this period. And therefore, then if we take not a too low frequency, not a too high frequency, if we take this together, but this is also not a law, and there is no right or wrong. It is again up to you what want I to do, that you choose here your right data. And therefore, if we want to do our analysis here, then we come to the conclusion that a reasonable choice of the frequency and the period length could be maybe choice of frequency. Frequency is then maybe monthly, and period length, well, Corona we cannot exclude because we want today analysis for today, but then I think we should exclude the financial crisis. So let's say we look at a period in between 5 to 10 years. Then period length 5 to 10 years. And also, if you think about which frequency, which period length, you always have to keep in mind, do I get the data for this? Oops, this we also do in red. That this is really important, that you think of your setup of your yeah, statistic experiment what I want to do, and that you really can argue why I have done this and this and this. And of course, there is no right or wrong. You have a good argumentation, or you can be, yeah, highly criticized for your choice you have made. And of course, here my choice can, of course, also be criticized. No way. Okay. Then we are going the next step, because now we are looking for the data. Oops. So, and this we want to do together really from the beginning. Of course, I have the data, and then I can give you the Excel file and we start, and then in 5 minutes we are done. But we have to ask, where do I get the data? So what we need is DAX. What we need is DAX titles. And what we need is Euribor. Let's maybe start with the Euribor. Well, if you are working at a financial institution, then of course you go to your Bloomberg terminal and you download your data and you are done. And since this is yeah, so important that you can do this, Michael Bloomberg, he was also running for the president in the United States. He was was heißt denn Bürgermeister auf Englisch? Major. He was mayor of New York, and he is also a billionaire, because in the 1970s he had the idea it could be a good idea to build a software where you can access maybe all financial data the guys in the institution can think of. And this is more or less a monopoly, and therefore he is a billionaire. Well, we are here at a small university, though we have no Bloomberg terminal. What do you think? Where can we get the Euribor? Well, of course, if we go to Google and we put in here Euribor, then we come to Euribor rates and consent. And then you here have the actual Euribor rate, which is minus 0.35%. Well, great. This is the first data point we need. But we have talked about 5 to 10 years back in the history. So then you can 5 years times 12 is 60. Then you can go to Google and you just say Euribor 3 months, January 2019. And we just look, what do we have? Oh, great, here we have it. So, oh yeah, I have to put it like this here, and then you see it. So now you can type in your single values. And now it's 11 o'clock, and maybe we are finished at 11:45 with our Euribor time series. What is the problem? The problem is that we have 40 DAX titles, and then we have the DAX itself, and this will take then a week or something like this. So you have to think about where can we just get data, and what can you think here, reference interest rates. Which institutions would generally provide these data for free for you? The ECB, of course, and we are here in Germany, so we can look then also at the German Bundesbank. But you will find it also at the ECB. Maybe I log some internet links for you and type them in onto the slide. So ECB, there you find the data in the SDV. This is a statistical data warehouse of the ECB, and here you get the direct link to it, and here you directly find also the menu and so on. So if you need any aggregate financial data, then you find it here. So here, this is a possibility, of course. Or let's take this also for the United States. There you have a nice little tool. This has the funny name Fred. And Fred is provided from the Federal Reserve Bank of St. Louis. And here you really find in a really nice way economic data in general. So if you put in here, for example, Euribor or LIBOR, let's see what we get. 3 months London interbank offered rate. So if we would have chosen the LIBOR, then you get here directly the time series, and up here you see the blue download button, so you can directly download this in the Excel format, the LIBOR interest rates. Okay, this I also give you at this point. This would be a possibility. And this Fred is also quite nice because there exists an Excel add-in. You can just download from the site, and then you incorporate it within your Office package, and then you can directly access it. So you have also Excel add-in. Okay, and then we are in Germany, and therefore I chose the Bundesbank. So here we are, and then we go to statistics. Bundesbank. Oops, this is, I have to take it a bit wider, because here now you have the really nice handy mobile phone version of the web page of the German Bundesbank, and on these mobile phone versions I say that you almost see nothing, that you are only scrolling and scrolling and scrolling, and you do not find anything. But if you increase it a little bit, so then then you have a bit larger menu, and here we find money and capital markets, and then you find here interest rates and yields. And then you go here. No, you don't see it here on the right side. Let's move it up a little bit. Here you have time series. And then we go down. Interest rates and yields. And I think we find it at whoop, whoop. Did we find it here? Money market, monthly we want to have. Yes, here we are. So, it's lower. So, money market, interest rate, monthly money markets, and then here Euribor 3 months. And then you can just download it. So then I take here the lecture directly. And this is the Euribor. So, oh, that was a Bundesbank. And I just copy this link here. And then I took the data here. So, now we have this data. So, and then DAX. This is also an aggregated variable. And therefore, we can find this variable, of course, also at the Bundesbank or at the large financial institutions. Hopefully I find it here. Maybe generally in time series. And here I have some search function. Do you see it? No. Then I have to move it a bit into this direction. And let's see. There we have it. And then you can click on this one. Up. Again, that you can see it. This is difference to period and so on and so on and so on. And oh. So here you may be wondering a little bit that you do not find here a number of 10,000, 13,000 or something more. But if you look at it here, and this you always, when you moving into some into the data, then you have to look what kind of data is it. And here you have the index is set to 100 in 1987. And yeah, since we are interested in the yield, then of course we have to calculate the monthly increase of it. So it doesn't matter if we take the index of 100 in 1987 or to 1,300 or what it started at this point. I don't know. Okay, so I think also we can download this one. And of course, this I also have to say, hopefully you already know this. I have taken the DAX performance index. And what is the difference between a performance index and and a course index? Do you know this? Have you made this? No? So within the performance index, you always calculating when you have dividends of your single titles of your companies, then you think of it that these dividends are directly reinvested in the company itself. And therefore, the performance index is much higher than the course index. And what you should know is that if you are going to the news in the evening at 8 o'clock in Germany, then in the end of the news, we at first go to Frankfurt. Actually, we are going to Eschborn and not to Frankfurt because the stock market has moved from Frankfurt to Eschborn, is very little village outside of Frankfurt. Yeah, the idea that it is in Eschborn was just because due to the major of this little village, because he said, well, stock market, please come to me. You pay only very low taxes. If you are situated not in Frankfurt anymore, there you have to pay very high taxes. You will just see the stock market Germany is also a DAX title, so a large company. And they are now situated in Eschborn and they pay their taxes just in this very small village. And if you go to this small village, then you have really nice swimming pools. You have everything is really, really nice because this very large company pays its taxes in only for this. I think Eschborn has around 10,000 inhabitants or something like this. Well, this is also a tax competition, we call this. Okay, so if you go to the news, this was the point, in the evening at 8 o'clock, then for Germany, it is shown the DAX performance index, and then they switch to New York, to the New York Stock Markets Exchange, and there we are talking mostly about, I think, about the Dow Jones. And what we see there then is the course index and not the performance index. And so, well, it is not really the same what we are comparing then. If we say the DAX has increased by 1% and the Dow Jones has only increased by 0.5%, because in the Dow Jones, it does not incorporate the dividends. But if you go again to the data, then of course you also find the course index of the DAX and you find a performance index of the Dow Jones if you want to compare these numbers. But I think you have to know that in general you are talking about different things if you are only go to the news. Okay, and then the hardest point for us, since we have no Bloomberg terminal, is how do we get the data for the single securities? How do we get the data for Siemens, for Bayer, for BASF, for Vonovia, and so on and so on? So what we are interested in is then DAX where we are. I think here is the list, the easiest way. Up. So you don't see it like this. I think now you see it, or yeah. What's this? I have to. It is a bit smaller, and now it is better. So again, here we have the daily data, and then of course you can always look at the first of the month. And all you also you can just type the number into your Excel sheet, but this will take quite a while. So, and there for this I told you there are some resources for free you can access, and one resource is Google Finance. And let's see, the first one was Adidas. If we just directly can access it, I actually don't know if this works. Yes, it works. So, and here, 5 years, then you have the data here. And what you could do then is, if you create for yourself, or maybe you have it already, a Google account, then you have maybe already seen that within your Google account, you have an Office package. And within this Office package is directly, of course, also implemented Google Finance. And then you have to look up the abbreviation of Adidas within the Google Finance package. Let's say, let's just look it up if I find it quite fast. Google Finance. Up. Adidas shortcut, maybe. Here we have it. RS, no, this is Yahoo. RDS. There it is. Where did we find it? But on the Google page we had it here. So here you see that RDS is then the shortcut which you then should choose, or which you then have to choose, and then of course you have some specific framework how to have to type in this. And I thought last week it's no problem. I take just Google Finance because I already had implemented this, and then I stuck because I found that in Google Finance you get only daily and weekly data. And then, of course, you could think about, well, it is not that hard to then get monthly data out of weekly or daily data, but you have then, yeah, in quotation marks, small problem that a month has not always 28 days or always 31 days, but it is always switching. Well, it is possible, but I'm not a Visual Basic programmer, and therefore I cannot do it. I don't know if you can do it. Then, of course, you can go to Google and look it up. How get I from a time series or from a daily time series always only the first of the month out? This maybe will take you 1, 2, or 3 days, and then you have it because you find in the internet. And this, I really say to you, really try this, that you use in a good manner the internet to find something you cannot do today, but you will do it if you go to the internet and really do research and looking for it. Then you quite fast find something which you want to do, and you learn very much. But this, for me, I thought it is too long, to look 2, 3, or 4 days until I can do it. And then the other source is Yahoo Finance. And there we take also Adidas. And if I click on this, then I get also Yahoo. Then let's click on here, 5 years. You see it? Yeah. You see it. And I'm logged in. There was just a download possibility where it is. Historical data. Then you have to click on historical data. And here you have, no, you don't see it. Now you see it, the nice little download button. And for this, you always have to look, is there a download button? And is there a download button without paying? And now you have here daily on the left side. And here it is. Here you have monthly. And now I download the monthly data. Oh, sorry, I have to increase the period. So let's take starting point the 1st of 2010, let's say. Then the most stuff from the financial crisis was done, 2010. And now we download it. And this is ISRD. So of course, now we have downloaded it, but then I would recommend before you start, well, everything is done. Now I do it 40 times and I have all my data. Please have a look into your data file. So I have now, this is maybe, this you can change, but this is quite good that is, I have done it like this, because then you say, well, of course there is all data, but what should I do with this? Because if I click in this cell, then all data is in one cell. I don't know. You already know what you do. You have to do? No. Okay. So then you see that all this data is separated by commas. Yep. And this is the so-called CSV format. And you can, do you see the menu above? Yeah. Okay. Though you go to data and then this is not enough, so I have to increase the menu. So, and then you have here text in columns. And now separated. And here you just read, of course, in German, commas, tabs, tops, and so on. And then we go on further, and here I can choose comma. And then you see below that he has already changed it. Maybe I think I just see I have to do it another way because at your laptop maybe this data is separated by semicolons. Is it true? Because I see that I already have changed my. Did I have? I just have to look something up because then it is maybe different. What you do? No, it's okay. No, your data. Have you already also downloaded? Okay. Because in a minute I show you another thing you have to think of, or you have to know if you just download data in Excel format from the internet. So, comma, and then we go further. Okay, this looks okay, and ready. And now we have here our monthly data of Adidas. So now we have a nice little problem that if we look at this adjusted close here, this is the end price. But could it be true that the end price of Adidas at the 1st of May is 169,640,427. This is maybe a bit enough. Well, in the end, if this number is somehow still true, and we just find in a minute that this is the true value, since we are interested in the rents, so in the potential increase, we don't have to care about it. But of course, we want to know, is it now 169 and then comma or something like this? And for this, then you just look it up, and then you see at the 1st May, hopefully 1st of May, we have here adjusted close. This is the last column here. This was then at May 2nd, 190.63. Oh, I have to, this is monthly. Anwenden. Here, I have to change this. So now we have this one, and here you see that if you have 169,64, and actually I don't know why he is doing this. I think this has some problem between the English website and the format which you have there, and then you have, we are here in Europe, and actually also Excel has then another format, because in the United States and I think also in Great Britain, you are separating thousands with a comma, and the point is our comma. Well, for this, I thought that it would be enough if I go here to more, so a bit slower, data. Oh, sorry, okay, yep, again. So now here, file, more, options, and is it large enough? Yes, options, more, and then you have here, should your system choose comma or point as a separator? And I already have done it. If you take this out, and then you have to look at your what is typed in here. And I think since you have not already changed it, there is at your software a comma in the first and a point in the second. And therefore, if you want to switch it, you have to interchange these. And if you take it then out, then the separator comma and the separator point are switched. Unfortunately, this does not solve our problem. I have tried it. I don't know why. And this is not incorporated directly. If I go now to OK, then I at first have to close Excel and then reopen it, and then it will take the new separators. And this also or you have to know, because sometimes you have a real problem. If you download an English or American version with points, and usually Excel has as a standard option that it just look up 19.06 is the 19th of June. And if you download the American version 19.06 as a number, then your German version interprets this as the 19th of June. And this is then the wrong value, because behind 19th, behind the 19th of June, you have, of course, also a number which is behind this date, but this is, of course, not 19.6. And these are just single things. If you are doing something with data from the internet, then you learn this. Just, well, I don't think that is really a good way to look this up from books or something like this, but just start to manipulate data, to download data from the internet, and then we learn what we have to do. So I have learned this the last 10 years or the last 20 years. Okay, so, but anyway, since we are only interested in the increase, this doesn't matter for us because the number is right. We only know that we have to divide this number by 1 billion. And if you want to have the real number, then just manipulate this and this, then you have only to do 40 times. And this, I think, is then possible within half an hour or something like this. Okay, so this would be a possibility to download now all 40 price developments of our DAX securities. Or, and this I also want to show you, is there is also a download directly implemented within Excel to access Yahoo Finance, or in general to access data from the internet. Have you already done something like this? How to access directly? So in this case now we download the Excel file and then we copy it to our Excel sheet. Yes, that it is. So then let's go within here. Do you see it? Yes. Yeah. Okay. So here, and then another sources, and then you have another sources from the web. So what's our internet doing? Here we are. And now this is quite nice because here you see already URL, and there you not only need the right URL in order to download it. And for this also I just learned this last week, because the other times I always used Google Finance, and then I saw, well, sorry, Google Finance has not monthly data. So then let's say Yahoo Finance download data directly, something like this. I don't know where we will be. So there are always, of course, some nice little YouTube videos. This we won't look at, but I think, is this possible? No, this is only downloading the Excel file. Excel spreadsheet, how to directly. This is always the CVS file. Okay, then I have to put in another keyword you don't know, but I know it. This is a query download, and now we should find something like this. Up, Stack Overflow. Maybe here. You always find some blogs or some internet sites, some chats rooms. As a query, do we obtain here a special? Here it is, for example. It looks then like this. Up. Can I increase this? Yeah. Up. No, it's a bit smaller again. Oh, this is an Excel add-in which you have to buy. Sorry. And let's go to something other. Where is it? Maybe here? No. Here I have it. This is one. Can I copy it? Yeah. So this is always then nice if you directly can copy it and you do not have to retype it. So, and then let's copy this and go here for our DAX titles. So at first I put also the Yahoo Finance link. This was, I think this one, yep. Put this up. Within here, no, this is not the Yahoo Finance link. Up. This is Google Finance. This is the Yahoo Finance link. This one, or this is directly from the web. And well, let's just see what we will find if we take this link and put it in here. Is it also possible for you?
Yes.
Okay, great. And then okay. And this is of course a try and error. Let's see. This looks quite good. Now he is connecting to the database of Yahoo Finance, and great, we find it. So I think NFLX, which kind of security could this be? I think this is Netflix. So, and what we see here now is, okay, again, this format that you have no comma separator. I think this is, again, the same problem we had before. And now it will take a while. And now you have here also the adjusted close. This is your end course. I hope that this is Netflix. Let's look it up. Netflix, Yahoo Finance. So 187, and we have downloaded data from 2002. The 11th of May was the last one. So roughly should be around 180 then. This is not the, so it is not Netflix, sorry. Then it should be some other one. But then if we have this, let's go and try a next one. Data, no, not. Data from web, where are we? Oh, there's data, so yeah, here we are. So again, data from the web. Take just another sheet. Now we take our wool we have and NFLX. We are not interested in NFLX, but we are interested in, here we see it, rds.de. So I copy this and then I interchange NFLX with ads.d. Okay, wait a minute. And here we are, and this looks quite good. If we look at this now, 164, if you remember it, this is now the course of the Adidas security. So, and for this, you then, I think, have a possibility to get quite fast the whole data. Then what else do we need? Where is it? DAX. The next one is Airbus. So let's go in here. Airbus, Yahoo Finance. And then you have here the shortcut AIR, oh not PA, Airbus SE. How is it called? How it is? Is it like this? Is it the right one? Airbus SE. Here, DE. This one is then the thing you need. For this, you always have to make a check then. Are you really at the same, at the right stock you really need? So please not only, well, the first link I have should need not be the right one. So you always, if you take the data and you do not have Bloomberg, then you have always to check, is this the right data? And then, of course, we want to have our 10 years. And for our 10 years, we have one problem, and then we stop for today. This is, let's do it again. Oh, no. I have here the link, I think. Because then you have to interpret the format here, which you have. Okay. Here I have the shortcut for my security. And then I think you also can think of that period 1 will be the starting point. And that period 2 will the endpoint. And then interval D, unfortunately, will mean what? Yes, the frequency, and this is the frequency daily. There, then you have to look it up. What do I have to change within that format? You can try 1M, but this doesn't work. But this would be the first guess. Just try it then. 1M to change the frequency. And then you have here as a starting and the endpoint here some large number. And for this, you also go to the internet and ask just the internet, what does this number mean? And this number means this comes from programming language Unix. And maybe you have heard of the 2000 problem of Windows. Windows, when it was invented and programmed, this was, I think, in the end of the 70s, beginning of the 80s. They do not have thought about that somewhere in the future there will be the year 2000. And therefore, dates within Windows were only programmed in 77, 78, 79, and so on, and so on, and so on. And this was really a huge problem for everybody in the world because many programs, they just take the date to do anything as a reference. And this would have meant that if you do not solve this problem, that at the 1st January of 2000, your date is switching to the 1st January of 1900. Just look it up in the internet. This was a really large problem for the whole world. And then we also thought, well, what will be with our timetables of trains, of buses on something like this? Have they managed this problem? Because otherwise, on the 1st of January 2000, there will be something with your timetables where your programs are going to the date because they have the wrong date. And Unix, they already started from some number counting just up. And therefore, I think if you just Unix time code, then you have here, for example, a converter where you just put in your time and then you convert it. So here you see this converter, this timestamp also times seconds. So, and then let's take just a number, oops, this one, and no, this doesn't work. Well, let's take this number here, the starting point. No, why it doesn't work? Sorry. So, convert. And then we know that is the 23rd May of 2002. Or here, this is what we're interested in, 2010, 1st January. And let's say and then convert, and then you have your starting point you have to put in at your timestamp there. Okay. This maybe you try, you have 1 week, because on Thursday we have Christi Himmelfahrt in Germany and it is a day off for us. Maybe you can try to download your data, and then what you have to do is we have, let's take delta RE is then our RE, this is your historical price, which we obtain, minus this. So let's take here, for example, for Adidas, I think the 1st May was 160. Let's say the 1st of April was 150. Then RI would be 160 minus 150 minus 1. This is your yield from month to month. Then this interest rate, your data you have downloaded was per annum, so yearly data. But since we have really low interest, or we have small, in absolute value, negative interest rates, you are allowed just to divide the yearly interest rate by 12 to obtain a monthly interest rate. So this one, then Euribor data has to divide it by 12. And then, of course, you can just calculate this. And this will be beta. This is our parameter which we are interested in, times Rm. Here we have always to take a t, because this is always, of course, moving from month to month. Rmt minus R0t. So, and this is the DAX performance. And then, of course, this with linear regression, but we will talk about this next week. With no absolute parameter. So in general, our linear regression is y a plus bx, but now we have no a in our case. We just assume that our a is here 0. So this parameter a will be set to 0 in our case. So the linear regression will then be delta will then be RIT plus ROT equals beta RMT minus R0T plus some error term. Because of course our data points will then scatter around our linear regression line. So maybe you can try to do it for one security. Just look how far you will come if you try it. And this we will then do together, and then we will calculate all 40 betas for all single securities of the DAX. Okay. Then let's stop this one.